when nobody sees it coming, that's when crashes happen in the stock market, right? Nobody expects it. You can look back to 2007 when the foundation started to crack in housing. Nobody really saw it was coming. Yeah, the Big Short, you have a couple guys here and there, but I mean, 99.999% of people didn't see it coming. Even the investment banks who were highly leveraged did not realize how leveraged their partners were until later on in 2008. Believe me, they didn't know, or they wouldn't have got that insurance from AIG, knowing that AIG would never be able to pay it out. Talk about that in a second. Credit default swaps. They didn't really know the full extent to it. But in 2007, unemployment rate was still low. The markets are floating near all-time highs. What do we see? Record profits. People buying tons of shit, mostly on credit, but who cares? They were buying stuff, which is great for the economy. It's what we want to see. More people buying stuff. But when you look back, nobody, not the Fed, banks, nobody understood how much leverage was in the system. And that even includes, I mean, look, the Goldman Sachs, Morgan Stanley, JP Morgan's, again, they were leveraged out the ass, but they didn't see the scope of it, where just a 5% pullback in home prices would crash, not just the subprime market, which some of them saw. Okay, the subprime market's definitely fuck. Oh my God. It wasn't a subprime. That's not what happened. It was the leverage of those subprime loans. The massive leverage where all you needed was a 5% pullback in home prices, and you saw a massive crash of the entire world's economy. Since most of these banks were leveraged over 30 to 1. But when we look back, that crash, that collapse, surprised 99.9% of the world, including almost every analyst and economist. I mean, even when we started pulling back, remember Kramer's on TV telling you to buy Bear Stearns. I'm not ripping him because he also told you to buy the FANGs 12 years ago, 15 years, even when I was working there, we talk about FANGs. So I'm not ripping them, but, you know, people didn't really know, even people on the inside, to the full extent what was going on. Most analysts would tell you to buy the dip. I mean, sell-side shops were upgrading stocks and reissue buy ratings on their favorite ideas. I felt even when we saw Lehman fail, right? We let Lehman fail, and the government was like, wow, you know, this is cool. Okay, we could let someone fail. We're not going to bail out anyone. And the Fed and government still had no idea the scope of this massive leverage and this bubble. Because that quickly turned. Remember, the markets did okay when they first let Lehman fail. And afterwards, like, holy shit, Lehman's tied to every single thing. It's all tied together. And the market started to crash again. Then the investment banks, they finally got it. In March, April, May 2008, that's why they all turned to AIG for credit insurance, buying credit default swaps, and actually going short now, reversing their positions. I mean, Goldman is classic for this. I mean, fully hedged. They own over $22 billion of these swaps, which actually bet against the failure of AIG as well. I mean, how awesome is that? That's fantastic. They're betting against AIG failing. And you look at Wall Street, I tell you all the time. I mean, they'll throw their mother off a bridge if they know they can make a fortune off it. If you're laying there and you have a sock on, they are going to take that sock off of you and give you nothing. That's Wall Street. You have to realize who you're dealing with. But AIG, they had no fucking clue. They had no idea. Because even though the banks were short, AIG did not have trillions to back this bet. They were just like, hey, yeah, it's fine. Yeah, we don't see it coming. Fine. I remember the Fed, the government, when they found out AIG, wait a minute, AIG's involved? How's that possible? It was great. But it's like in The Big Short, if you read the book or saw the movie, sometimes you're too right to where the market crashed so much there was nothing left to get paid from your short positions. It's almost like suing an insurer, a small insurer, for $50 million and winning. That's awesome. High fives, everybody happy, lawyers, everybody getting paid. That's great until they go bankrupt and you get no money. Now, what happens? Nothing. Kind of the case of AIG. So where am I going with this? What's the history lesson for? Why am I boring you to death with this crap? Because on CNBC, this is on Monday or Tuesday, there was a story titled 20 Strategists Predict the Next Time and Size of Stock Market's Next Big Bubble. 20 strategists. Of course, you had to pay for it. It's funny that you have to pay for that, even though these are people that are going on CNBC and they're providing research, right? Goldman Sachs. So basically, CNBC is selling Goldman Sachs research to everybody else, which I think is funny. That's okay. That's fine. But the first thing I thought when I saw that headline is you should be long stocks. Because we're probably not going to see a crash come for a while. Why is that? I mean, the story, again, 20 strategies, the next time in size of stock market's next big bubble. Why? Because crashes don't come when everyone expects it. That's the one certainty. The one certainty that I can give you from my close to 30 years in the markets. They don't crash when everyone expects it. They happen when nobody expects it, when your guard is down. And the fact there's so many skeptics out there, including you, including me, including a lot of the public, right? That's usually a great thing for stocks. That's what you want to see. You want to see people nervous. You want to see people that they're not all in. The skeptical market's going to crash. That's a good thing for stocks. It's bad when the whole entire world is bullish and swinging to one end of the pendulum, because what happens? You're going to swing, and usually you swing a lot further than you ever think. Just like during the credit crisis, just like during COVID. We fell a lot more than what people thought before coming back. Now, you heard me warn about inflation a few months ago. Felt like I was early to the party. The inflation argument, that's probably the first time that I made that argument of something that really worried me in my career. I can't remember talking about inflation. To where, runaway inflation could really crush the world economy. And why is that? Because it removes the safe haven of the Fed as a bailout option. So you have to print less money, stop buying bonds, or tighten. You have to tighten monetary policy to stop it. You almost have to force a recession. So it takes the Fed out of the equation. This isn't bailing out someone with money. Oh, whatever. JP Morgan was over leveraged and they're in trouble. Okay, well, we're going to backstop them and they're going to be fine. No, the Fed can't do anything when you see runaway inflation. They have to say it's transitory, because if they don't use that brilliant word transitory, which means we don't care if inflation goes forever, because it's going to be temporary. Even if it's like 6 months, a year, they're not telling you, right? 6 months, a year, 2 years. They're not telling you what transitory means. It's brilliant. It's a brilliant strategy to say transitory, because it allows them to keep the machine on without worrying about where inflation goes. Otherwise, if they didn't say it's transitory, what do they have to do? They have to tighten right away. Taper, whatever the word they want to use. They have to. They don't want to do that. They're not going to do that heading into midterm elections. Huge. No way. The Fed is a political body, no matter who it is. If it's Republicans, Democrats, it's a political body now. It's not separate. No way. When I was talking about inflation, very few people were talking about it back then. I remember getting emails saying, Frank, come on, inflation, look at the 10 years, not here. I'm like, man, don't you see the labor shortage out there? You see what's going on in the world? I mean, come on, you guys have to see it. But nobody was really predicting inflation, other than like the Dents and Schiffs, who were predicting massive inflation every year since they were like 12 years old. I'm not talking about those people. Just, they have an agenda. They're going to say, no matter what facts change, they're never going to change their opinion. This is what they believe. That's fine. People love following that, cults and stuff like that. That's good. You're going to lose a lot of money doing that, but I understand. I understand that people just follow cults and they need to be told what to do. I understand that. I get it. Investing in anything outside of what those two guys told you to invest in over the last 10, 12 years, you would have made a fortune, and with them, you wouldn't have made anything. It's besides the point. But you look at inflationary market, to me, it was pretty obvious. Injecting $10.5 trillion into an economy in a way where it was going directly to consumers. It was a check going to, wasn't like the credit crisis. Well, let us backstop the banks. This way they make them look safe, and it'll be up to the banks to lend, and we have rules with the banks so they can lend and how much they can. No, this is, hey, just keep throwing the checks. Give it to them right in the bank account. Boom, 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 boom. And then what did you do? You open everything up at the same time. The economy's fine. We're good now. Everything's cool. And what are you going to see? You're going to see massive demand, massive shortages to build products. Makes sense. Which then leads to rising commodity prices, which leads to higher costs for businesses, which forces what? It forces them to raise prices. That's the definition of inflation. However, over the past 6 weeks or so, we've seen Ian Cooperman talk about inflation, warn about inflation. Ray Dalio, Druckenmiller, Gundlach, these guys are a lot smarter than me talking about inflation, making public statements that they're very, very, very worried about inflation. So for me, how do I look at that? Because now that everyone's talking about it in mainstream media, it's no longer a massive risk that nobody sees coming. Again, even the Fed, the past few meetings, talked mostly about inflation, how it's transitory and all that bullshit, right? That they're talking about it now. But again, markets don't crash from something that everyone is talking about. They crash when nobody expects it. When the public is totally confident, totally bullish, when they're all in, it can't go lower. And you know what? We don't have those conditions today. I mean, stories like the one I mentioned, CNBC, I see them all the time. I'm connected to everything, right? All these stories, people sending me stuff. Again, Bloomberg, if it's Thomson Reuters, if it's Wall Street Journal, you name the source. But I read this stuff all the time. Even in the newsletter industry, how the market's going to crash 50% next month. It's going to happen on September 7th. 50% crash. Be prepared to buy these gold stocks, even though gold stocks tend to fall even more during crashes. But buy these gold stocks. You're going to make a fortune. I mean, they know fear sells, right? That's how they generate revenue. Tap into the emotions of people. Think about the media, Delta variant. Is it spreading? Yes. Is it causing more hospital visits? Yes. Is it deadlier? No. Not even close. Much less deadly than the original strain. Nobody cares. They're not going to tell you that. They're not going to tell you that few people are dying. They're going to say, hey, hotspot areas are here, hotspot areas are there. It's got to mandate masks now. And we'll talk about it later, but mandate in New York, first place to mandate that you need the vaccine to go indoors. Are you kidding me? You need to have the vaccine. You need it. Even though if you get the vaccine, you're safe. You're perfectly fine. But I need everybody else to have the vaccine. Everybody else must take it. I don't care if you believe in it. I don't care if you don't. I don't care if you got COVID already and you have antibodies in your system that obviously are lasting longer than antibodies in the vaccine, right? Since they're providing booster shots. But yeah, people with COVID already not really getting it. You see some few isolated cases and, I had COVID. I had the COVID shot. Who was it? I don't know. It was McConnell, one of those Republican leaders. Got the vaccine, and now I got COVID, and even said, he goes, it's very mild. Very mild. It's not bad. But still, it's not deadly. But why are they pushing this issue? Everyone take the vaccine. You got to go crazy. Their job is to scare the shit out of you. Because you watch more TV. They make more money from advertisers. Politicians, makes all the sense in the world. They gain more power, more control. That's what they want. That's what every politician wants. We all know that by now. I don't care what side you're on. If there's one thing we could agree on with Democrats and Republicans here, is that the mask mandates that are going on right now, people are freaking fed up on both sides. That's the one thing we've come together. Enough of this crap. Enough of it. But it's all a system. And even in my world, right, when it comes to Wall Street, analysts and market pundits, right, every time they make a prediction, it's like, hey, I'm bullish on the markets. Almost every time someone says they're bullish on the markets, they have to follow it with the word but. We're going to see a market crash soon. I'm bullish up to next year, but I can see the market crashing soon. You know how many times I heard that over the past 10 years? Market's still near all-time highs. Not only is that a bullshit forecast, since analysts love to hedge themselves, like politicians these days, right? They're never going to admit that they were wrong. Say, hey, if the market crash, I told you it was going to crash. If the market goes high, I told you it was going to go higher. I said, yeah, later on, we're going to, to me, that's useless. It's useless. Absolutely useless. But hey, you make some crazy forecast. That's how you get on TV. That's what people want to see. They don't want to see you go on TV and say, hey, you know what? The markets are cool here. We're going to see a steady trajectory higher. Earnings are going to be pretty strong. They don't want to hear that. They want to hear either it's a 50% market crash or we're going to continue to hit new record highs going forward. It's going to be insane. That's what they want. That's what people want. People love to be entertained. That's how we're built. We need entertainment. If you have any doubt at that, just look wherever you are right now. If you're at wherever you're listening to this, maybe you listen to the car, so don't look. I don't want you to get into an accident. Everyone's on their phone. Everyone's on their phone everywhere. You walk to a mall, I'm not just talking about kids, even adults. Everybody's on their phone, even at dinner tables. Go eat dinner. Look at the couple. They're not even talking to each other. They're on the phone. Everyone's on the phone. They need to be entertained. Need to listen. I got to read stuff. I got to watch. That's how we're programmed. That's fine. But it's almost like, as an analyst, you can't say you're bullish publicly without also using the word but, right? This market will overheat and eventually crash sometime in the future, right? That's the way it is. But here are the facts right now that you need to understand. Interest rates are at record lows. The Fed has no intention on raising them anytime soon, especially into midterm elections. No way. Corporate profits are at record highs. Surging. You're looking at the quarters these companies are reporting. I mean, you can't say, well, they're higher as a percentage. I'm not talking about higher as a percentage. I'm talking about, forget the percentages, the actual earnings. Holy shit. And some of these companies are killing it. Margins are accelerating, meaning these companies have incredible pricing power. And Facebook raising individual ad prices by 47% last quarter. 47%. And getting it. I've been in supermarkets lately. They're selling 12-pack case of Coca-Cola, canned soda for $7. One case. You could buy 3. You could buy 2 for like $7.50, and then they give you 1 for free. $7. And you know what? People are buying that. They're buying them at that price. Corporate balance sheets have never been stronger. Wait till you see the amount of buybacks that are coming. Can't say, companies announce that they increased their buyback. It's to more buybacks, but a lot of this is going to happen after earnings season. They're in a quiet period. See companies buy back. You just see much more announcements going forward. What was it? Micron, first dividend ever. I mean, we got so much freaking money. Fuck it, let's just pay a dividend. It's crazy how strong these balance sheets are. You have our banks who used to allow massive leverage, were able to take on excess risk with their own balance sheets, generate profits. They can no longer do so. You have regulation, Dodd-Frank. You have the stress test to keep them in check. This regulation doesn't allow them to take on massive leverage anymore, so that helps avoid another credit crisis. Do we have a lot of leverage in the markets? Absolutely. But you have to put things in perspective. You can't talk about one side without talking about the other, because household wealth is at all-time highs. People have so much money. Now they're spending it on discretionary stuff, which we're seeing in the numbers. They are also paying down credit card debt and putting cash towards savings. Savings rate is at 9%. That's about 50% higher than the average savings rate over the last 20 years. I mean, you do not see that. You do not see that ever. When people are saving, that's bad for the economy. It means people are spending less, and if they're spending less, companies are generating fewer profits. No, they have so much money that's working. We're saving. We're paying credit card. Look at JP Morgan. I'm not making this stuff up. Just look at they were like to a surprise, which is a negative, that people are paying down their credit card debt. And they're saving more money. That was amazing to me. I don't remember seeing that. I don't remember seeing that in a bull market ever with stocks at all-time highs. See, when you pull back, you want to be a little safer, put money in savings. No, they're doing everything. They got so much money. Hey, do whatever they want with it. You look at productivity through the roof. New technologies, faster internet allow companies, people to produce much, much more in less time. That continues to get better and better. M&A near record highs. You have a good business model, you have a good idea, you almost certainly get funded. Especially you know the right people, you'll get funded. You have a company that was successful that you sold to somebody, especially in technology, biotech, or whatever, and you want to start a new company, you're getting funded. It's $30, $40, $50 million, like nothing. Like nothing. It was a company that was just bought by Blackstone, $900 million for Reese Witherspoon's company. By the way, some of the things that she's produced on HBO and little things, just so many great movies, series that I saw dedicated to women and stuff. Had Nicole Kidman. I mean, fantastic. Good for her. $900 million. Holy cow. $900 million. That's huge. You get funding anywhere. And as for the inflation argument, when you look at inflation during the early stages, it's great for the economy and businesses. That's what the Fed wants. Yes, it's getting ahead of itself and it's a little scary. But it's much, 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 much better than deflation. As long as we don't see double-digit, crazy runaway inflation, we should be okay over the next few years. Then people say, well, what about the valuation argument? We're trading at 21 times forward earnings. That's a huge number. It is a huge number. I mean, the average over the past 5 years was 18 times. The average over the past 10 years was 16 times. However, you have to take everything. You can't just point out one stat. We have interest rates at near record lows. Record lows. And we're in a market where it was just flooded with money. Now we're opening up to the world. You're looking at a market where earnings are expected to grow north of 12% over the next 12 months, while sales are expected to grow north of 7%. That's probably 3x higher than the projected gains annually that we've seen over the last 10 years. I would say maybe 3-4% earnings have grown, maybe a little bit more than that. 12%. At 12%, The S&P 500 earnings at that kind of growth rate, 21 times, is not an expensive valuation. It's not. You can't say it's expensive. You also have interest rates record lows. Again, they're going to stay there for a very, very long time, which is great for companies and borrowing. And then we got the million-pound gorilla, which is the Fed, who will refuse to let our markets even correct a little bit without throwing tens of billions into the economy almost immediately, whether it's buying bonds, extending benefits from the government. And you look at fiscal and monetary policy. But on the monetary side with the Fed, it's, keep interest rates low, keep buying bonds. Why? Record profits, GDP back to normal. And we have a clear runway of our growth right now. Unemployment is low. It's probably not going to go any lower because they continue to get benefits. They continue to extend them in some states. But it's crazy. But when you take everything as a whole, guys, we have a market with favorable bullish conditions.